Welcome to coaching session 6. We're going to be talking about put selling as a practical investing strategy and a way to generate income. And we will also talk specifically about the rules set up around the Rebel income system that you see me write about on the Investive website and in the Rebel income blog. In my experience as a trader, the best results in generating consistent, immediate, and conservative income using the options market simply comes from trying to keep things as simple as possible. The advantage of put selling is that it provides a way to generate regular income at higher average monthly rates than you can achieve using traditional so-called safe interest bearing instruments like CDs, bonds, and treasury notes. We've built the Rebel income system specifically to leverage the income generation capability of put selling to provide a useful gateway to ownership in fundamentally strong stocks at attractive prices. The combination forms the basis for a long-term approach to wealth generation that few average investors are able to achieve, but that is hardly out of the reach of even of any average investor. Let's go ahead and dive into some of the details. Let's talk about put selling in general. There is a general misconception about what it means to sell a put, and that it is a very aggressive, even speculative strategy associated with high risk. The first and most common reason for selling put options is the same as for selling a covered call. It's really to generate income. When you sell a put contract, the money that comes in for that contract is applied as an immediate credit in your brokerage account. You're then free to use that new cash as you wish. The other reason to purchase a stock you're already interested in, the other reason is so that you can purchase a stock that you're already interested in at a discount. If the stock goes up, or excuse me, if the stock drops from its current price to the strike price that you sold or below it, then you're going to buy the stock at that at the strike price. If the stock reverses direction and goes after you've been assigned and you own the stock, then you're going to you'll have the opportunity not only to keep the income from selling the put, but also by starting to possibly leverage covered calls a little bit. In any event, selling a put contract means that you're bullish about the stock, since in the long run, you're best served by seeing the stock move up in price. The reason that I like to use put selling as a gateway to stock ownership, as I like to say, is it allows me to set a price set the price at which I'd like to own the stock. The strike price I sell will usually be a price below the stock's current price when I place the trade. If I believe that the stock represents a fundamentally strong company with an interesting value proposition, then selling a put option at a lower strike price means that I'm getting an even more attractive price for the stock if I am if I am assigned, than what I would pay by buying the stock at the current market price. This reality of being willing to accept an assignment from a covered call is one of the reasons that I believe put selling is not the overly aggressive or speculative strategy that most experts would have you believe. As long as you're doing it around the basis of fundamental strength, around the basis of attractive stock valuation, with the understanding that in some cases, what you may be looking at is a long-term position in the stock. A practical reality about put selling is that while put option sellers won't be in position to make as much money as option buyers in the near term if the stock goes the way they want, In the long run, their returns will almost invariably exceed those of directional buying-driven investing strategies. And by what I mean by this is that if you buy a call and the stock moves the way that you want, if stock goes up by 10%, for example, on the call, you may double your money. You may achieve a 100% return on that trade. With a put sale, you may our target return on any put selling trade is about 1.5% per trade on a monthly basis. That's a clear difference, 1.5% to possibly 100% per trade. The difference and the reason that I believe that put selling provides a more reliable way to build wealth is because of three critical time-driven elements that I really believe make selling put options a better way to achieve long-term results. First, if you plan the trade correctly, you're usually going to be in the trade for no more than about a month. The average duration of a Rebel Income trade right now is a little less than 20 days. That provides a very short window of time for the stock's price action to determine whether the trade will result in an assignment or a simple expiration and release of the money that you've allocated to that position. Now, with a shorter window of time per trade, that means that put sellers can increase the frequency of their trades. If you consider a single trade as an allocation of capital to secure a potential stock position, that means that Rebel Income is designed to target about 12 trades per allocation per year. With an average of about 19 days per trade with Rebel Income, that currently translates to between 14 to 20 trades per year per allocation. You'll see me publish and highlight new trades in the Rebel Income blog every week, which means that if you manage your position sizes conservatively, being able to place 52 income generating put sales per year is extremely practical and functional. The final element is the primary differentiator, I believe, between traditional trading strategies, what I like to call directional investing, and what we aim to achieve with Rebel Income. Directional option strategies are any method that require you to buy to open a trade, buy a call, buy a put. So these would be strategies called long calls and long puts. Study after study, and even my own experience in the market over nearly 3 decades as an investor and market educator have proven that these strategies these directional strategies are wrong far more often than they're right. In fact, the odds of success in these trades have historically proven to run between 20 to 25% for even the best, most experienced and professional traders in the world. It is possible to make money with these strategies, even with a very low probability of success. However, the reality that you're going to place a much higher number of losing trades than profitable trades means that average investors are placed right behind the curve immediately out of the gate, and it makes long-term achievement of investing goals and needs more difficult. The biggest reason that the difficulty has increased for average investors is the biggest reason this is true is because the vast majority of option contracts expire worthless rather than being in the money on their expiration date, which means that as much as anything, successful investing in the options market is a function of time more than it is price. Now, remember that options have a finite amount of time attached to them. Over the years in my own investing, I've watched one stock after another move the way I wanted it to when I bought a call option or a put option. The problem was the move ultimately, in many cases, didn't come until after I was forced to close the trade because I ran out of time. Seeing it happen time after time was really frustrating, but eventually forced me to realize that if buying options automatically put me behind the time curve, selling options was a way to put myself ahead of it. I've been managing the Rebel Income system and writing about it in my blog for almost a decade, and I've been using the precepts that we're talking about in this session. We've managed to shift the probability of success from this very low probability number, 20 to 25% that we were just talking about with directional strategies, to more than 97%. Now, that doesn't mean that stocks don't go down or go below the price that I was assigned at, sometimes well below the price that I was assigned at. But it does mean that the occasions where we've been forced to recognize a loss are few and far between. With a higher probability of success, 97%, means that being able to take in a conservative target yield of 1.5% becomes a lot more attractive. Now think about this for a moment. If the reality is that the vast number of options expire worthless, and you can expect to be right about the direction that a stock is going to go only 20 to 25% of the time when you buy options under the best circumstances. That means it's no wonder that you need to try to hit home runs on every trade, why people are often trying to double or triple their money in these option trades before they take their profits. It's also the reason, understanding that you are going to be wrong 75 to 80% of the time, is also the reason that even with some of those big hitters in terms of gains, the losers often far outweigh the profits that you make in the losing trades. That is the difficulty of learning how to manage a directional options trading system. And the vast majority of average investors, myself included, simply have not been able to pull it off. One of the things about what we're talking about right now with regards to put selling and Rebel Income is that this system has been developed as a natural reflection of my own evolution as an investor. As I have tried to understand how to work the probabilities of the market in my favor, and I've began to understand that if I can be right far more often than I am wrong, 80% or possibly more, then being able to take in 1.5% profit per trade on an average monthly basis starts to make a lot more sense and starts to become something that becomes a lot easier to build a total investing system around and to make a central part of what I do in the market. Okay. Now, with all of that said, there are some functional realities that we need to understand when it comes to put selling. There are two main types of put selling trades that can be placed. And if you talk to your broker, they will typically use one of two terms. The first is naked puts. In simplest terms, a naked put is selling a put option without sufficient cash to cover the cost of assignment. Now I'm using a very simplified example. We've got a stock here at $50. If we sell one contract, which represents 100 shares on this $50 stock, that means that we are giving the buyer of our put option the opportunity to require us to buy the stock from them at $50 per share. That creates a $5,000 obligation that we may be forced to meet. In order to fulfill that obligation, we need to make sure that we have the capital available to cover that obligation. A naked put implies that we may not have enough cash in our account in order to cover the cost of that assignment. This is why put selling requires a higher level of options permission from your broker than, say, simply buying a call or buying a put or even placing a covered call trade. In the case of a naked put, that means then that if you don't have enough cash to cover the overall cost of the assignment, then you have to borrow money from the broker to do it. And that's called margin. Now, margin requirements and costs vary from broker to broker. And so the numbers that you see here on my slide may not reflect the reserve requirements or margin requirements for your broker. Make sure that you contact them, talk to them to make sure that you are clear about what their requirements are. But in this case, we're going to try to simplify our numbers as much as possible for illustrative purposes. And so we'll work with a 50% margin requirement. That means that for our $50 stock, selling the same one contract, one put option contract for the same potential 100 share obligation means that we only need to have $2,500 in available cash in our account. Now, in order to secure this margin ability, you will almost certainly need to have a lot more capital in your account than $2,500. And so this is not implying that put selling would be available for small accounts. This is only an illustration of how the margin requirement would work. If you have $2,500 in cash or other assets available to begin covering the potential obligation of this $50 stock, then the broker will lend you the additional $2,500. Now, of course, lending money to you from a broker is certainly not going to be done without margin, interest, and fees. Again, these numbers will vary from broker to broker. They will also, in terms of interest rates, will vary depending on economic conditions at any given time. So make sure that you check with your broker to understand exactly not only what their margin requirements are, but also what margin interest their margin interest standards are, and what kind of fee structure they may have set up beyond regular brokerage commissions for option trades when you work with margin. These will be additional costs you will incur. This is also where the majority of the really scary stories about the dangers of put selling come into play. If, for example, let's suppose that you, instead of only selling one contract on this $50 stock, let's suppose that you sold let's suppose that you sold 100. That means then that you would be you could be obligated to buy 10,000 shares of this stock, which means that your potential obligation would be on the order of $500,000. If you're doing it on margin with the margin requirements on this slide, that means that you would be borrowing $250,000 from your broker for the duration of the trade. Not only would you pay margin, interest, and fees on that $250,000, but if the stock then, in the worst case scenario, not only drops below $50 for your assignment, but then continues to drop, the further that it drops, the more money you will be losing, and your broker will only allow that to go so far. At some point, they will issue you a margin call. A margin call is a essentially calling a loan due, which means that you would need to be able to cover the amount of the loan they have given you, the $250,000, plus margin and interest and fees within a certain amount of time. Now, if you don't have that cash, that additional cash available in your account, then you need to go find it, whether that means selling additional personal assets or whatever other methods. So this is where the really scary stories about put selling come into play, where you may have heard of people losing homes, losing other personal assets and property. It is often because they have been selling puts on margin at and significantly over leveraged themselves in terms of the amount of margin they have taken on, and don't manage their trades effectively on the downside. The flip side of a naked put is what is called a cash secured put. The focus of Rebel Income, as much as possible, is to emphasize cash secured puts rather than margin, using margin, for all of the reasons that I just mentioned. We are trying to make this as conservative as possible, and so ensuring that when you sell a put, you always have sufficient cash to cover the cost of an assignment becomes a priority. That means with the same $50 stock and the same $5,000 possible obligation on selling one contract, you would have $5,000 in cash available in your account for the duration of the put selling trade. It would sit on your account in reserve, unavailable for additional trades. If you're assigned, then that $5,000 will be allocated to purchase the shares in that stock. If the put option expires worthless because the stock finishes above $50 at expiration, that means that the $5,000 capital reserve requirement is released to your account, and that same capital is now available to reuse on another trade as you may wish. One of the really big differences, besides the lack of requiring margin, not having to pay margin interest and fees from your broker, is that cash secured puts are available on a larger number of accounts. In cash accounts, the requirements that most brokers place on approving an investor for cash secured puts are lower than for naked puts requiring margin. Margin is also not permitted in qualified retirement accounts like IRAs, Roth IRAs, as some self-employment retirement plans, some of those kinds of things. Depending on the broker, cash secured puts may be made available within an IRA account. Again, this does vary from broker to broker. Not all are willing to accommodate this strategy, but it is permissible under regulatory guidelines for qualified retirement accounts because of the absence of margin and the reality that you are required before you can ever place a trade and to ensure that you have the cash available to cover that obligation if an assignment occurs. Okay, we've covered some of the basic elements related to put selling. Let's get down to the nitty-gritty and talk about the trading rules that we like to apply in the Rebel Income system. You'll see me outline each trade that I post on the ITG website, excuse me, in the Rebel Income blog. You will see me highlight each one of the elements that I'm about to outline. So first, the value proposition, which we talked about earlier in one of our earlier sessions. is looking for a discount to our fair value calculation of at least 15% or higher. As much as possible, I like to target stocks with a value proposition of at least 20%. But under certain circumstances, under certain market conditions, I may go down to as low as 15. But we are still looking for a significant healthy discount from the stock's current price to where we believe the stock's fair value price should be. I make sure to publish exactly where I believe that fair value price is for each trade that you will see me post. The fundamentals also become very, very important. For elements like earnings and revenue growth, we want to see steady improvements on a yearly basis as well as a quarterly basis. These imply that business is improving, that management is successful at growing their business on a sustainable basis, on a useful basis, excuse me. Free cash flow is a way to verify that growth shown by earnings and revenue growth if it is also increasing. And is a good way to evaluate whether or not items like a company's long-term debt may be serviceable. The balance sheet that is published with every quarterly earnings report is also very important. We pay attention to elements like cash and long-term debt and try to evaluate whether those numbers are improving, weakening, or static over time, and what those may suggest or imply about financial flexibility and ability the company has to expand via acquisition, to invest in research and development, or to return value to shareholders through practical methods like paying dividends or stock buybacks. The operating margins, when I use the term operating margin, I'm referring specifically to the evaluation of net income over time. Not only over the last year, but also I compare the last year's net income number to the most recent quarter to see if net income is strengthening. To arrive at a reasonable way to measure that, I calculate net income against a company's revenue over those same periods. And if I see those percentages improving, then I am confident that the company is successful not only at growing their business, but also at managing their costs effectively. And that is a further confirmation and support for the potential picture that I hope to see by increasing earnings and revenue growth, as well as increasing free cash flow. As you know, it's also important to pay attention to the stock's current price action, as well as its trends. Since Rebel Income is built as a value-oriented trading system, it does focus on take a kind of a contrarian approach to looking for opportunities to place practical put sales and possibly buy stocks by looking for stocks at or near their historical lows. Under ideal circumstances, it's true that stocks in long-term downward trends often continue those downward trends for an even more extended period of time. And so one of the things that we do try to look for within these trends are signs that the stock's price is beginning to consolidate, which implies stabilization. We can see a clear pattern of consolidation and stabilization, then often that is an early indicator that that downward trend may be about to reverse direction. If the fundamentals are also healthy, the value proposition is also attractive, then what we have is what we believe to be a fairly ideal mix of all three elements working together at the right time. All right, we've been talking a lot about the stock. Now let's go ahead and spend some time talking about the rules around selling a put option. First of all, we talked about selling time and trying to put time on our side. Remember that options have a finite time to life. And so if I am buying options, my purpose is to try to minimize the effective time decay as much as possible. When I'm on the selling side of the transaction, I want to leverage time decay. That means selling less time is better. There is a temptation among many people who practice put sales to sell more time because the premiums are larger and appear more attractive in terms of the immediate income that comes into your account. The Rebel income system is built to leverage time decay by selling 1 month or less. I mentioned earlier that right now the average time to expiration on our Rebel income trades is about 19 days, so less than a month. As much as we can get down below that level, then that is our preference. In many cases, not always, but on a number of cases, we're able to make functional put sales within less than 2 weeks of time, and in some cases approximately 10 days to expiration. These are circumstances that offer interesting setups that allow us to take advantage of time decay even more. But our target is 1 month or less on average. There's also a question of what strike price to sell. Again, in terms of what may look more attractive, there's also a temptation to try to focus on strike prices that are closer to the stock's current price. Since we're selling a put, in some cases, people will be tempted to sell put options with strike prices above the stock's current price. Remember that when we're talking about trading on U.S. exchanges, we are talking about American style options. A reality of American style options is that assignment on a put sale can come at any point leading up to the option's expiration. There's a difference between American style and European options, where European options are only exercisable on the expiration date. Exercise with American style options, calls or puts, can happen at any point that the stock's price has moved in a favorable direction for the option buyer. That means that if you are selling in the money put options, you are tacitly accepting the possibility of being assigned the stock at that higher strike price. To try to minimize that risk, and also to ensure that if we are assigned, we're purchasing a stock at a price that we are happy with and willing to accept an assignment for. We look to actually sell out of the money in every single case with the Rebel income system. The number of strike prices out of the money does vary from trade to trade, depending on current market conditions, as well as what we're seeing from the stock itself. Under normal circumstances, we will usually be looking to sell out of the money by at least 1 to 3 strike prices. Exactly how much that varies, or exactly how far of a distance that represents from the stock's current price, depends on a number of different factors, but often gives us a little bit of a buffer of $1 to $2 or more in some extreme cases from where the stock's current price may be. That ensures not only that if we think the stock is attractive at its current price, that taking an assignment occurs at an even more attractive price than when the stock where the stock was at when we placed the put sell. If you are selling the at the money contract, which means the option that is closest to the stock's current price, we always tried to make sure that that is the out of the money option in any event, for the same reasons that that we've already outlined. As I've already alluded to, the target yield on these trades is about 1.5% per month. Now, I want to take just a minute and I want to demonstrate something about yield that a lot of people don't understand. Now, if we think about the compounding effect of trading frequency, we can start to put into contrast what it means, or what it may mean to in terms of total return for our account over time. Now, if I think about an average return of 1.5% per month, know that there are 12 months. I could multiply 1.5 by 12 and say that my annual target return is about 18%. That is actually relatively conservative, and we've been able to prove that that is generally eminently doable on the capital that we commit to our trades. Now let's consider this same 1.5%, but let's use some of the average numbers that we're running with Rebel Income right now. We have an average of 19 days per trade right now. That means that over the course of a full year, 365 days, we divide that by our 19-day average, we may actually be able to place 19 trades. I'm going to round down here since I can't place partial trades with options. Now, if I think about that same 1.5% over the course of 19 trades instead of 12, my potential average return increases to 28.5%. Compared to the same 18% that I'm saying I would be very happy with on an average monthly basis. This means that we can achieve far superior returns. Now, the stock market by itself over the last 50, 60 years has averaged in the neighborhood of 9 to 10% average annual return per year. That's factoring in bear markets, recessions on multiple occasions over that time period, as well as overall upward trends during bull markets. That's an average 12% annual average, of 9 to 10%, and which means that if even managing our trades on a conservative basis for Rebel Income, if we can achieve 18% or even this 28.5% that I am showing you right now, we have a reasonable expectation not only to have a functional investing system, but to do a far better job on a long-term basis in building not only practical income, but also the kind of long-term wealth generation that we may be looking for, than we may be able to do simply by trying to follow the market and by trying to match the overall return of the stock market, perhaps by buying an index fund or something along those lines. All right, let's talk about the final element, which is understanding what happens at the end of a put selling trade. There's going to be one of two results when we get to expiration. The first potentiality is that the stock is at or above the strike price that we've sold. If that happens, the option will simply expire worthless. That means that the potential obligation that we have sold to the put buyer will go away. The capital that we've reserved for the duration of the trade will then be released back to the account to be able to be used for the next trade in our sequence. That for many people is considered the ideal result. And it is a very attractive result, but it does not have to be the only one. The other potentiality, the other possibility that we have to be aware of and think about whether or not you're willing to accept is an assignment. Rebel Income does not shy away from the potential for assignments. I've already used the term gateway to stock ownership when describing Rebel Income and the value-oriented system that I've tried to build. That is because my mode of operation is to accept whatever the final result of the potential trade is. If I am assigned, that means that is a stock that that by placing that put selling trade anyway, I was already saying that I would be willing to own the stock at the strike price that I was selling. So with that logic, accepting assignment only seems natural. That means owning a stock I already like that pays healthy dividends and gives me an opportunity to continue to leverage the stock's dividends as well as covered calls for additional income purposes. You may not want to accept an assignment, and there are things that you can do before and leading up to the day of expiration to try to manage those expectations depending on market conditions. Specifically speaking, since you are selling an option to open the trade, you can always buy it back from the market to close the potential obligation before the option expires. If the stock is sitting below the strike price that you sold and you buy the option back from the market, you will absorb a loss. The size of the loss will depend on the distance of the stock's current price from the strike price that you sold. For a lot of our investors who like to use put sales but don't want to accept assignment, that is simply an acceptable cost of doing business. And so they will factor that into their trade management strategy. We will talk more about trade management in the sessions that follow. Okay. That pretty much wraps up the elements of put selling and the Rebel Income approach to selling put options. Let's talk about what we're going to be focusing on in session 7. In our next session, we're going to talk specifically about dividend paying stocks. What happens if you accept an assignment, and the advantage that dividends give you in accepting those assignments when you're working with a stock that you believe offers a useful value proposition in a fundamentally strong company. I'm going to talk about taking a long-term view and understanding what that really means. We'll also talk about how to differentiate dividends from each other. We'll talk about the difference between dividend quality and dividend yield. We will get into all of these details in session 7. Thank you so much for your time. We'll see you in the next session.